back. After rebounding over the last two sessions, the market sliding pretty hard today. Is this a sign that there's more pain to come? We're going to answer that question for you. At least we're going to try. Welcome to Futures Now. I'm Jackie DeAngelis, joined today by Rachel Chisholm on the floor of the CME. And here with me, Anthony Grisanti. Grizz, let's go ahead and start with you and talk a little bit about what we're seeing in this market. We are expecting to get some earnings tomorrow. We're going to get JP Morgan and also Wells Fargo. Do you think that earnings are going to have the potential to save this market?
You know, either potential to save it or potential to slide even farther from where we are. And I think investors are a little worried about earnings. These earnings reflect what happened during the bad weather months of this winter. So a lot of companies have warned on these earnings. And the other thing I'm looking at is I'm not surprised that this slide or this volatility is happening around tax time. I think the tax ramifications of people having to pay them might be causing them to liquidate some of their long positions and some of those profits that they enjoyed for the last year and a half in stocks.
All right, that's interesting. Rachel Chisholm, want to get your take on this. What do you think is behind this selling at this point? Are you seeing anything in the technicals that indicate that we should be seeing this kind of drop in the market?
Absolutely, Jackie. This is the reversal of the reversal of the reversal. As we drop right in here into the pocket, if you will, at 38. If we close below the previous low of 30, it's sayonara. The market's below the trend line. We definitely go lower. I think what you're seeing is a little bit of a defensive play going into those earnings you noted. We did see some interesting buying in Greek bonds last night, and also our 10-year note yield dropped substantially. So what I'm seeing here is a little delevering in the equity market going into perceived safety. We saw a pop in gold. This, I think, is a defensive play for not only tomorrow, but the next week of earnings.
All right. Well, obviously a rough day for the market today, as you're describing there. Let's go ahead and bring in Marc Faber. He was predicting that we would see a market decline much like this. Marc, always great to have you on the program. Thank you so much for calling in.
Well, thank you very much for having me.
Let me ask you this. The decline that you've predicted on this show when we've talked to you in the past, you said it was coming. Is this it? Is this the start of something greater to come? A lot more selling on the way?
Well, I think the last time I talked to you was in February, and then I said that these momentum stocks like Priceline, Netflix, Tesla, and so forth would sell off. And I still think that they are very vulnerable. Now, are utilities vulnerable? I don't think so. And so forth. So we have to distinguish. The market is a very big place. The Fed prints money. The money will go somewhere. So I think there are some groups of stocks that are highly vulnerable because they're in cuckoo land in terms of valuations. They have no earnings. They value that price to sales. And this is not a good matrix in the long run. And other stocks are very depressed.
Well, let's get a little bit specific and drill down. When you talk about some of the stocks that were highly valued, is that what you think investors are finally noticing about these stocks? The internet names that you mentioned, the biotech names, is that what's driving this, or is it more of a momentum play here? And then I want to ask you about the names that you're saying are very depressed. What kind of names are we talking about, and should investors be looking at those?
Yes, good question. First of all, I think most investors have little knowledge of what eventually some of these internet-related companies and social media-related and biotech-related companies will earn. All I can say is that I'm on the board of several mining companies. Biotech is similar. You have no cash flow at the beginning. You have to continuously do research and development. You have high expenses and so forth. And maybe some will work out and some will be successful and lots of others will fall by the wayside. So it's very tough to really know which ones will be the big winners and which ones will be, and the majority will be losers. If you ask me which stocks are depressed, then I can say coal stocks are very depressed. Precious metals, mining stocks, silver, gold is very depressed, although they've rebounded strongly from the lows last October, November, but they're still, by historical standards, very depressed. So it's a tough environment, but I believe the market is slowly waking up to the fact that the Federal Reserve is a clueless organization. They have no idea what they're doing. And so the confidence level of investors is diminishing in my view.
Okay, well, let me play devil's advocate for a moment to that point, because other people would say this is just a little bit of a technical blip, some short-term volatility in the market, and that really they do have confidence in the Fed. They do think that the Fed is going to continue with its easing program, even though it's tapering slowly, and they don't want to fight the Fed. And actually, there's really nowhere else they would say to put your money. So that means the market should go higher. Listen to a clip from Squawk Box this morning. They had Legg Mason's Bill Miller on. Listen to what he had to say. He really stated the bull case.
We may be in the best bull market that we're likely to see in our lifetime, coming off that 660 level. If we can maintain very low inflation, if interest rates are secularly low, if growth can continue globally at a slow pace, valuations are likely to get a lot higher.
Mark, what do you say to Bill Miller?
What I'm saying is he's a very smart individual. He's a very likable individual. He's also been terribly wrong at times. And he said one thing that I think people overlook frequently is if inflation stays low. The question is how much longer can the Bureau of Labor Statistics lie about the true cost of living increases in the United States and elsewhere? All of you who live in New York, you know how much costs have gone up over the last few years. Food prices are going up, energy prices are up, and so forth. Healthcare costs is up. So I think that the money that the Fed is printing, it is true it will go somewhere, and they will continue to print. Actually, I have argued that they will increase the asset purchases in time, especially if the S&P drops 10 or 20%. But the money will flow maybe somewhere else, and that could be price inflation.
Okay, well, let's talk about how low we could go. You just mentioned maybe a 10 or 20% drop would trigger some Fed action. Do you think that's what's going to happen here?
Well, lots of stocks are down 20% already. A lot of biotech stocks, a lot of social media
right, but those
stocks.
are sectors and stocks specifically. I'm talking about the S&P. Not a 20% drop, but a 10% drop potentially?
Well, I think this year, for sure, maybe from a higher diving board, the S&P will drop 20%. I think rather 30%. But, I mean, who knows? But all I'm saying is it's not a very good time right now to buy stocks. And I've recommended to own stocks since 2009 because I saw that the money printing would lift equities. But at the present time, there are very few stocks that are particularly good value. Vietnam is good value. Iraq is good value. Some Chinese stocks are good value. Some Hong Kong shares are good value. But they're not across the board good values around.
Mark, let me go give you an opportunity here to go out on a limb and sort of make a bold call. Do you think that we're going to see an 87-like crash here in this market? Is that what we're bound and destined for?
Yes, I think it's very likely that we're seeing in the next 12 months an 87 type of crash. And I suspect it will be even worse.
All right, Marc Faber, we're going to leave it there. Thank you so much, as always, for joining us, and we love having you on the show and getting your perspective. Meantime, Rich, Grizz, you heard what Faber had to say. He left it on a very negative note. In some ways, that's not very surprising, but he is saying that potentially we could see a stock market crash here. Rich, I want to get your take and say, how do you trade the S&P when you hear what he says?
Well, one thing I agree with Mark about is that the Fed doesn't know what they're doing right here, right now. I'm convinced that the statements from the Fed here in the last month have added to volatility right here in the marketplace. First, we get the taper timeline change or the rate change a couple of weeks ago. Now we backpedal with this last statement yesterday. I think that adds a lot of worry to people that we do wonder what's going on and do they know what's happening here. I think this function in the market right here, right now, however, is tax selling. Our big guys are delevering, raising capital to pay bills from last year. We also know earnings are coming. Defense wins games. That's exactly what this play is. And the technicals are pointing lower. If we close, Jackie, below that 1830 level today, which was the low from 3-4 days ago, we are definitely going lower. I disagree with the market coming unglued and getting a 20% correction, but I think a 3 to 5% correction is healthy. I think it's going to happen. I wanted to sell the market today. We looked at the trades when we put the trade out. Any pop today into the close, I'm a seller at around 50, and I think the market tries to break the 30. I want to stay short, and if I miss the sell on the upside, it goes through 30. I'm just getting short.
All right, Grizz, what do you make of that trade?
You know, Jackie, I love the trade. I really do. And, you know, Rich, the other thing, too, is the Fed might be clueless, as Mark said, which I completely agree with. And the other thing is, at the same time, they're pulling back from the market. So investors had that backstop of the Fed all these years. Now it's only $55 billion purchased versus $85 billion. So now we have to look at the fundamentals of the market. We have to look at earnings. We have to look at revenue. We have to look at the things that actually matter. So I think investors are a little worried that those things don't measure up at this point, and this market definitely is a sell.
All right, gentlemen, let's go ahead and leave it there on that note and get the risk reward on this trade. Rich is selling the S&P. Rich, correct me if I'm wrong. You're selling at 1874.75 and targeting a drop down to 1838. Since each point counts for $50, go ahead.
I missed that trade, Jackie. That trade's left the building. But what I would do is sell it up in the 50s. Same type of stop. Yep, and look for the market to retrace lower.
Okay, got it. And since each point counts for $50 here, what's the risk reward on the new trade?
Well, I'd put a 20-point stop, risking $1,000 to make $2,000 on the downside. 2-to-1 ratio. If we get up into the 50s, I'm selling it. Follow me on Twitter. I'll update the trades.
Got it. All right, we definitely will follow him on Twitter.